You already trust a company you've never audited with your money, not your local bank, not the FDIC. A stablecoin. $73 billion sit inside one company's digital dollars right now, promised to be redeemable one for real cash. This week, that company asked Washington for something it didn't strictly need to keep operating: a federal bank charter, not to take deposits, not to make loans, just to look officially like the kind of institution people already trust. This already happened. 189 years ago, a different set of dollars asked for the exact same kind of trust. Most of them didn't deserve it. So here's the actual question. If a stablecoin already promises to be worth $1, why does it need Washington's permission to be believed? In 1837, Michigan had been a state for exactly 1 year, and it already had a plan to get rich without bankers getting in the way. The new law was almost absurdly permissive. Any group of landowners with $50,000 in capital could open a bank. No charter from the legislature, no real oversight, just a deposit of bonds, or sometimes just mortgaged land, as security for the paper money the new bank was about to print. Roughly 40 banks opened under that law in about 2 years. State examiners later found that only about 17 of them had security deposits large enough to actually cover the notes they'd issued. The mechanism was almost elegant, in the way a con is elegant. A bank printed notes, dollars in name, backed by land nobody had properly valued, or bonds worth less than the state pretended. Then it located its office somewhere hard to reach, deep woods, a bad road, a place note holders wouldn't bother traveling to for redemption. Historians later gave these institutions a name that stuck: Wildcat banks. The story goes that you'd have to hunt a wildcat in its own den just to get your money back. Michigan's first bank commissioner, Alpheus Felch, spent 1838 and 1839 traveling the state to check what was actually sitting in these vaults. More than once, he ordered a bank's reserve boxes emptied onto the floor in front of him. Some were packed with scrap iron, weighted to feel right, with a thin layer of real coin spread across the top. Picture a farmer outside Ann Arbor, paid in a crisp new $10 note from a bank he's never seen and will never visit. He could spend it locally at a discount because everyone already knew the game. Merchants relied on published pamphlets called banknote reporters, listing which notes were trading near face value and which were trading for 60 cents, 50 cents, sometimes far less than the dollar printed on them. Not because the note was counterfeit, because nobody could prove the bank standing behind it could actually pay. By the end of 1839, Michigan's free banks still had roughly $2 million in notes outstanding. When the dust settled and the state finally forced redemptions, note holders got back, on average, about 39 cents for every dollar they were holding. In 1839, that made you an early adopter. It also made you broke. But here's the part that should sound familiar. The law itself wasn't illegal. Michigan's General Banking Act was passed by the legislature, signed properly, entirely on the books. The problem was never that the banks were breaking the rules. The problem was that the rules never required anyone to prove the promise was real. That gap is exactly what the banknote reporters were built to close. Published monthly out of Philadelphia and New York, they priced hundreds of banks' paper against each other because the federal government offered no single, trusted dollar to compare any of it to. The discount was the market doing the regulator's job, one merchant's guess at a time. New York ran its own version of free banking in the very same years and did it differently. Real bonds, real state examiners. Economic historians describe New York's note holder losses across the entire free banking era as negligible. Michigan's note holders over the same stretch lost on average 61 cents of every dollar they held. Same idea, on paper, a wildly different outcome. Because trust, it turned out, was the only thing actually being sold. A stablecoin is, mechanically, a banknote with better graphics. It says this is worth $1 and asks you to believe it, the same way a note from a bank in the Michigan woods asked a farmer to believe it in 1838. The industry has already had its own version of a bank run. In May of 2022, a different kind of stablecoin, Terra USD, was supposed to hold its dollar peg through an algorithm rather than actual cash reserves. It didn't. The peg broke, the token collapsed toward zero within days, and an estimated $40 billion in value was wiped out. No banknote reporter existed to warn anyone in advance. There was no federal regulator to call. There was only a discount appearing all at once, the same way Michigan's discounts appeared the moment people stopped believing. For most of the short life of stablecoins backed by actual cash and short-term treasuries like USDC, the answer to "why should I believe this" has still been read the audit, trust the reserves, take the company at its word. Which is exactly the arrangement a banknote reporter existed to police 2 centuries earlier, because trusting the printer alone kept blowing up. This month, Circle, the company behind the stablecoin USDC, received final approval from the Office of the Comptroller of the currency to open something called Circle National Trust. The charter doesn't let Circle take deposits or make loans. It places Circle's digital dollar infrastructure under the same federal regulator that oversees national banks, with direct federal oversight eventually extending to the reserves backing every one of those digital dollars. Circle's own chief executive described it as a step that brings, in his words, blockchain technology and digital assets into the core of the U.S. financial system. Read plainly, it means roughly what New York's stronger banking law meant next to Michigan's disaster: proximity to a real regulator instead of distance from one. Every other stablecoin issuer is watching because this isn't an isolated move. Ripple, BitGo, Fidelity, and Paxos have all pursued the same kind of federal trust charter within the past year. Nobody running a serious operation wants to be the one still operating out of the equivalent of a bank in the deep woods. Here's where the comparison earns its caveat, because it would be dishonest not to draw one. A Wildcat bank's note was only as good as a promise nobody could verify until it was already too late. A modern stablecoin's reserves, whatever their flaws, are auditable in something close to real time. Its transactions sit on a public ledger anyone can inspect. A federal trust charter adds an actual regulator with genuine examination power, not a single overwhelmed state clerk trying to police 40 new banks in a single year. The mechanism rhymes. The tools available to check it do not. Watch what happened once the gap between trust and verification got too expensive for the country to keep tolerating. In 1863, Washington didn't simply charter a few of the better free banks. It effectively ended state-issued paper currency altogether and replaced the entire patchwork with one federally backed dollar. Congress has already taken a first step down a similar road. A federal stablecoin law passed last year, generally known by the acronym GENIUS, set baseline reserve and disclosure rules for the whole category, rather than leaving each issuer to seek its own private arrangement with its own state regulator. Circle's trust charter is one company choosing to go further and sit directly under a national bank regulator. It is a reasonable bet that others follow, because the alternative, again, is looking like the bank still operating in the deep woods. The pattern playing out now, one company at a time seeking its own federal seal of approval, has historical precedent for ending a different way still, with the government deciding it would rather regulate an entire category at once than charter it company by company. That's not a forecast about stablecoins specifically. It's a mechanism worth recognizing before the next regulatory headline lands. You already trusted a company you've never audited with your money. The only real update this month is that Washington finally agreed to look over its shoulder, the way it once had to look over Michigan's.